Will the Fed need to do more for longer? Hi, everyone. Welcome to the Real Vision Daily Briefing. With us today is Diego Parilla, Portfolio Manager at Quadriga Asset Managers. Hi, Diego. Nice to see you.
Hi, Maggie. Thank you for having me.
So it's a fantastic time to catch up with you, given all of the sort of macro things that are going on in the market, so many different asset classes having an influence on each other. And I think we saw a lot of nervousness in the markets today. I mean, it's been kind of a volatile week, but we saw a lot of nervousness today as we wait for that big payroll number out in the US tomorrow, Friday morning. A lot of concern about what that's going to mean for Fed policy. How are you thinking about this market environment right now? Where's your focus?
Well, I guess one of the biggest themes is what I would define as monetary divergence. We basically have central banks around the world taking quite different paths, and I would probably break it down in three groups. One is the Federal Reserve, which is basically pushing ahead with the hikes. Everyone is behind the curve, but the Fed is the one that is leading the charge. They have to do it. They can do it. They are doing it, and they will do it until something breaks. And I think at the speed and size in which things are happening, things are bound to break either domestically or externally through dollar debt, etc. The second group, I would say, are central banks like the ECB that are in a way hiking and easing at the same time. So they're reluctantly hiking rates, from negative nominal yields, which was a massive mistake that I think they finally acknowledged, to at least positive yields. But as you notice, at the same time as they were hiking, they can't afford for yields to go and peripheral bonds like Spain or Italy to blow up. So they're in effect putting together a program that it's de facto yield curve control. So they are in a way putting the brake in the, trying to hike rates at the same time, ready to ease aggressively. And I think there's a third group, people like China, that are, in my opinion, in deep trouble and actually easing. So this monetary divergence is very meaningful. It has a big impact on the dollar. It has a big impact on exchange rates, how inflation is being exported in a way. And unlike previous currency wars, where it was all about bigger than ever and in a way gaining competitive advantage, this time around the Fed is much more comfortable and happier with a strong dollar as they are kind of passing the problem. So I think this monetary divergence, how people are able and dealing with inflation in different ways, is really what's driving things. And this is happening in a world where there was pre-existing fragility, bubbles that are certainly too big to fail, and a lot of hidden risk that we're starting to see, and more to come. Last week we saw, the UK and issues on UK pensions, which nobody had in the radar, and I think there's way more to come as this volatility and divergence takes further strength.
I think that's such a great way to put it. And especially that point about this hitting a global economy that's already fragile and had some hidden risks. Well, as you were talking about that central bank divergence, I kept thinking about sort of, a playground, schoolyard game where everyone's pulling on strings like with different strength, and it's sort of like a group tug of war, and somebody falls over. The rope breaks somewhere, and it's a really frayed and fragile rope. That was the image that was coming to my mind as you were talking about that. And it's such an accurate description, it feels like, of what we're going through. The minute you say something will break, they will go until something breaks. I know we're going to have a ton of questions about that. I can hear it right now. So if any of you listening want to comment, head over to the chat on the YouTube page or tweet us using the hashtag AskRV. We'll get them in and try to get as many to Diego as we can. You'll know from hearing me talk about it all week, the live chat function on our platform is temporarily disabled as we upgrade. So if you were used to commenting there, go ahead and throw them in the comments page, or head to the YouTube chat or to Twitter. And that's where you'll be able to get them in. And we're going to get it to as many as we can. So it's interesting, Diego, because Jim Bianco tweeted out earlier, caught our eye, that the probability of a 75 basis point hike on November 2nd is increasing now in the low 80% range. And he was saying at 8:30, is either going to go up to 100% or it's going to collapse. I think speaking to the volatility that we're all feeling. this is a Fed who keeps messaging that they're going to keep going. And yet, we saw and we hear from people that they're getting questions from clients still about a Fed pivot. Will they continue to hike through breaking something? Or, are they going to get that call from another part of the world saying, listen, the system is faltering. We can't take it. I think that's why the pivot question won't die. What do you think?
Well, clearly central banks are trapped. They're trapped between two big problems. One is inflation, and the other one is bubbles too big to fail. So the bad news is both are their fault, or they created both in a way. So I think the negligence of the past, not just months and years, but decades, this complacency, this idea that you can actually solve problems by printing money and debt. It's proven to be false. It's proven to be a misconception. You don't solve problems by printing money and debt. You do a few things. You delay the problem. You kick the can down the road. You effectively spend your way and borrow your way through the next generation. The second thing you do is you transfer the problem through currency wars and its mirror image, trade wars. You transform the problem into things like inflation, which unfortunately lead to things like inequality and social unrest and wars. And lastly, you enlarge the problem. You create these bubbles that are too big to fail. So I think the damage is already done. Sadly, it's a situation where you took things yields to negative nominal yields. I mean, this was completely an aberration. It was changing the rules of the game. It meant that fixed income could trade to infinity. It meant lots of things that the put call parity relationship between equity and credit, the duration of the system. It was just completely crazy. And I think some of those imbalances are there, and some we can see them clearly, some are hidden. And I think the Fed is not just about inflation; it's also about inflation expectations. This is when they really get worried. This is when things start to get out of control. And in some ways, I think the fact that they're hiking so fast, 75 basis points is by all means super high by historical standards, and they're not doing it once; they're doing it several times. It to me, it just shows, it's the admission of their own mistakes and incompetence or negligence by effectively neglecting the issue, which many of us could see coming. And by now, you're doing it so fast that we need to remember that monetary policy has a delayed effect. It's like nuclear radiation, or going to the beach and getting all this sun. You feel okay until you get home at night and you're completely burnt. It will take a little while for these hikes to go into the system. And I think as a word of caution, we went through this in a similar way in Q4 2018. And you remember we took rates to 2.5%, and the expectations that we would go significantly higher, and things started to happen. GE was pretty much gone. Ambev, people that were serial buyers, through debt, started to blow up. We've gone past through those points, way past, and we're edging for 4.5%. In a situation that, in my opinion, is significantly more fragile than it was. So I think this dynamic is tricky, is dangerous, but they are obviously showing their resolve towards inflation. I think they're correct in doing so. It's a super big problem. And I think there's some really big things happening here. One of them is the acknowledgement that perhaps negative rates or even zero rates was a big mistake. And I think looking forward, we should, and we may be in a world of positive nominal yields. The second question is, to what extent will these massive hikes break something and effectively create a recession that destroys demand and brings deflation, or at least reduces the level of inflation? I think that's quite likely as well. The big question comes, what's next? Are we going to be in a world where effectively real interest rates, nominal minus inflation, are positive as the market is predicting today? Or are we going to be forced to effectively do something and intervene to avoid the collapse? A little bit like what's happening in Japan, or what I think Europe is positioning for, which is, look, I'm hiking rates, but I have to have a contingency plan through yield curve control, which means I'm going to print even more to prevent the bubble in credit collapsing. And what this means, in my view, is inflation structural. It's going to remain very high, and therefore we're going to have deeply negative real yields for the foreseeable future. And this is a very significant change to what the market is pricing today.
Wow. Okay. So I think we have to take a step back and really absorb that. So I was thinking about this in a way of, can the central banks contain inflation and maintain financial stability at the same time, or do they have to sacrifice one for the other? And it sounds like you're saying they cannot hike rates at this pace, or hike rates and push them up and leave them up without creating massive financial instability. They're going to cave, they're going to have to address that, and they're going to have to let inflation stay structurally higher. Is that right?
Yes, 100%.
That has huge. First of all, okay, so let me get a question in first, and then we'll backtrack from that incredibly important thesis. And underscoring, you're saying the market is not priced for that at all, which is very important. So, Tristan asking on behalf of all of us, when, Diego, do you think, when will something break, and what happens then? Thank you for the great job you're doing, he says as well.
Well, I think things are already happening. I mean, you see some of the pickup in volatility, some of the things that are happening. We've seen, if it depends on where you're looking, but to a certain extent, perhaps one of the markets that is the equity markets, which is the one that people look at the most, have had what I would say is a correction of excessive high levels. Some of it is part through interest rates and duration and PE. I think next is going to be how you are effectively looking at margins and earnings, and how valuations potentially correct from that. But ultimately, what really matters, I mean, ultimately equity markets are important, but the real strain in the system is credit, and credit has been under severe pressure for a while now. And as I mentioned, I think in some areas like Italian bonds, which they were under a lot of pressure earlier in the summer, you've actually had to come in and in some ways intervene to prevent the yields from going and put in a lot of additional stress in the system. And I think Japan is also a good case study because they're leading the way in the monetary side. And we saw this idea that I keep insisting, yield curve control is the word, because ultimately you have a situation where you build too much debt based on the idea that at zero interest rates I can afford infinity, rates will never go up, inflation will never be a problem, and turns out that inflation is a problem, and you can't let rates go up because you blow up. And when you try to control those yields by, guess what, printing more, turns out that your currency devalues aggressively. Look at what happened to dollar yen since they tapped on yield curve control, and effectively the devaluation of the currency means inflation. So it's not just about the price of crude oil going up, it's also the price of crude oil in yen or euros or yuan. And so I think there's just too many things happening. There's a lot of stress. I keep also talking about not just the obvious leverage that we can see, also hidden leverage. And one of the things that worries me a lot and we pay a lot of attention to is volatility. If you think about how people look at risk, the concept of value at risk, the famous VAR, it's very much a function of volatility, but it has other very critical dimensions. And when things go wild, when the VIX breaks 40, I use the analogy that markets are a bit like fluid mechanics. We have a laminar regime when things are linear, predictable, and then once you go into chaotic, into turbulent, things dramatically change. And I think I'm using 40 in the VIX as a kind of finger in the air is a good reference. But at that level, 2 plus 2 is no longer 4. What I mean is, as volatility explodes and your value at risk explodes, and if you're a day trader, you last 2 minutes. If you get margin calls, suddenly you start to have forced liquidation, deleveraging. This creates and starts to impact the second key variable, which is liquidity. Things start to thin out, people get more nervous, everybody has the same positions, and then guess what? Correlations start to polarize. And we've seen, Ray Dalio, all-weather fund, having probably the biggest losses ever because of this idea that you would be protected by correlation. And turns out that correlation is flipping in a way that not only you're not protected, you actually have hidden leverage. So I just caution against some of the things that are happening. And so far, we haven't really had a proper break in the VIX. If we had volatility, which is already super high in FX. I mean, look at the euro, which has been for ages with a 5-6 handle, is trading, 14% vol, or sterling, which is gone. I mean, I think the equity volatility on a relative basis actually doesn't seem that high, and it's been very disappointing. But I think if it breaks, it's going to show that process. And I think the relationship between volatility and equity markets is very powerful. It's a bubble anti-bubble relationship, and it's very dangerous because when volatility is artificially low, you get people sucked into buying the markets. Trend followers, risk parity, vol target are forced to buy the market, and then when volatility spikes, they need to effectively throw everything out. And so these are relatively mechanical process that we see in the markets. But yeah, I think risk and volatility are going to be very high. Mommy and daddy are no longer there coming to the rescue. It's going to be a much more open game. Inflation, I think, is structurally high, which also changes the dynamics of the game. So major winners and obviously major losers, more importantly. And yeah, so I think this is going to be a volatile and risky world. And don't get me started with geopolitics and other external dynamics that pose
I know
additional risk.
it's fraught, right? And so, I mean, it sounds like for all that, a lot of people open up their, retirement fund, they look at their equity portfolio and think, oh my God, it's been horrible. It's been so bad all year that, maybe we're turning a corner and maybe we're putting a base in. I hear you say this is the warm-up session. Like there are hidden risks, there's hidden leverage, there are things going on that we're just starting to see crack, and that the big show is still to come.
Look, I don't have a crystal ball, and I'm not going to claim that we know exactly what's going to happen. But clearly, I think we are in a new paradigm shift. Things have changed, and I think if you're trying to play these markets the same way, as expecting the same behavior as the last 10 years, I think you're in for a surprise. Things are changing. Things that worked then are no longer working. In fact, are the worst thing you could do. And look, it's tricky to say. I would agree that what we've seen has been painful, but it hasn't been by any stretch of the imagination distress in a big way. And I don't know to what extent will they let these things go, as you asked earlier. Will they just let it crack? Because the problem is, once things start going, once things like the VIX really explodes and it triggers this mechanical process of forced liquidation and deleveraging, it's actually very difficult to stop. Yeah. Because this is very mechanical. So in some ways, I think investors need to be cautious. I think the key thing is when you build your portfolio, I always use these analogies, like sporting analogies, but looking at a portfolio as a football or soccer team, lots of people were playing with 11 strikers, just, not worrying about defense because the referee would whistle offside or mommy and daddy will come to the rescue with the central bank put. I think this is going to be a bit more tricky, and perhaps eventually we will have that mommy and daddy effect through yield curve control and other ways. But they have to fight inflation, and again, this is all just things that have been created through this monetary and fiscal abuse. So have we seen enough? I don't think so. when will it happen? How aggressive? Time will tell. But there are a lot of things that are already happening, perhaps more fragile than we appreciate. And I'm sure the central banks are monitoring closely.
Yeah. And, this has been said many times recently, but bears repeating that, when the genie is out of the bottle, it is very hard. You're kind of sweeping up the debris if they're pivoting. So the idea that that would be a positive market, um, event is not. There would be widespread damage that was unleashed. Much like the hurricane we just saw in Florida, and it may be part of the cleanup, but you don't want to be in that that zip code when that happens. You said something really interesting in one of your notes that you sent over that I want to get your thoughts on. And you say we're talking about being defensive and investors being careful in this environment. And you say investors confuse a portfolio of many things with a diversified portfolio. That seems to me to be extremely important point. What do you mean by that?
Yeah, I often talk about the idea of what I define as false diversification, and this is basically confusing two things. My portfolio has a lot of things, and my portfolio is diversified. I'm sorry to tell you, a portfolio with many things is not necessarily diversified. And I will use a bad example, but if your portfolio has 20 cryptos, you're not diversified. You probably have just one trade. So in that sense, that effect, it's happened in a bigger macro scale. And guess what? If your portfolio, and this is a very common mistake, right? Investors like to see their 20 lines in their portfolio green, all at the same time. Guess what? If all the 20 lines are green, you might see all 20 lines red. and that's in a way this idea. First of all, thinking about the portfolio as everybody needs to score goals. They're all strikers. Let's just make a ton of money. And it's ironic, but financial insurance tends to be cheapest when you need it the most. It's often when the markets are super high, implied volatility is low, nobody wants to buy the insurance, and then things happen, and suddenly everybody is rushing for the insurance. And in my opinion, the going back to the analogy that the portfolio is like a team. At the end of the day, you're the coach. You decide, okay, how do I want to play? How do I, what's the strategy, and what are the players that I'm going to put in the field? Do I want strikers, midfielders, defenders, goalkeepers? And some of them you do your own. Some others you outsource. I mean, we are effectively a defensive macro volatility player, and ultimately, this is not about having a crystal ball as the coach to say, oh, the next 10 minutes, we're only going to attack. So let's just put 11 strikers. Or, maybe they will come and shoot occasionally. No, this is a structural game. You need to build a portfolio. And, Barcelona football team, when they play a third division team in the Spanish Cup, they still have a goalkeeper. They still have 4 defenders.
Yeah.
So the fact that you might win the match doesn't mean, let's just go all in. And I think this, it's very obvious when I say it like this. And some people perhaps thought that some of their players were defenders, but turns out that, the correlations could change. And I think this is the reason why, again, going back to the all-weather fund from Ray Dalio, you see this larger than usual losses because they were relying on some players to be defenders when, in fact, they weren't. They were doing own goals and all sorts of stuff. So this is very important to drive your car looking through the front, not through the rear mirrors, because if you look through the rear mirrors, then you're bound to have some surprises. So past correlations, past relationships work in the past, but things are changing, and we're in a new paradigm shift where you need to think about things differently. So very, very important that people understand the risk of false diversification, because ultimately it leads to more risk than they thought, and perhaps levels of risk that they can't tolerate, and effectively lead to forced liquidation, which is one of the worst things that can happen. You want to be in a situation where when the crisis comes, you're in a position to take advantage of it. If you have hidden leverage or excessive leverage, chances are you're going to be completely blown out of the way and taken out, which is not the idea.
It's such fantastic advice. I mean, this is a master class in how to deal with the kind of environment we're in now, in this macro space. And when we say that, right, we mean big picture. It's not just equities, it's bonds, it's currencies, it's stuff, frankly, some of us may have not been laser focused on. Not the case with Michael. We're going to try to get some questions in here and see if we can steal a little bit more time away from Diego. So these questions are fantastic, by the way, folks. Michael asked, great right this month. Thank you. Can you suggest asymmetric ways for retail to play the Hong Kong dollar break? This is one of the, I know, currency pairs that you are looking at closely, and you see a lot of strain in this space, right, Diego?
Yeah, look, I think the ultimate view is on China. And I go back to the previous question where we discussed monetary divergence. I think we have a very clear case between the U.S. and China. It's no secret. I believe China is possibly one of the greatest bubbles ever on the infrastructure space, on the real estate, and there's so many levels where perhaps China is in a situation that will force them to do more of the same, which is bailing people out, nationalizing stuff, providing subsidies, and spending and borrowing. And one of the key things to understand is that all these things eventually lead to currency devaluations. 100% of the time, when you abuse monetary and fiscal, it leads to currency devaluations. This is the degree of freedom in the system. And I think the yuan has been positioned itself as the next kind of contender for reserve currency. I respectfully disagree. When you look at Hong Kong, and I did a podcast a little while ago, they asked me for one trade idea. I said, look, let's pick up something that is perhaps not in everyone's radar, but it is effectively linked to the China weakness. In some ways, I expect the China weakness to materialize, the yuan to go, which we're seeing now. So we're very heavily positioned in insurance through options there. And as you do that, you kind of see one of the next pieces of the domino further down being the break of the Hong Kong dollar, which I think in hindsight, we might look at this and say, well, it was so obvious, right? I mean, 39 years, it survived, amazing stuff. But look, it's a lot of things have happened. But if this was, for the Hong Kong to be pegged to the dollar through a currency board means that they need to follow the steps of the Fed on a basis point by basis point. So I'm just going to make one point. This is probably one of the most or biggest bubbles in real estate in the world. And now interest rates are going to be at 4, 5, 6, 7%. So you don't need to be a genius to understand that there are going to be a lot of things, a lot of pressure, and obviously many other things adding up. So that, I think it's, you could have the counter argument that they're sitting on plenty of reserves, which is true. My counter argument is why spend precious bullets called dollars to defend the undefendable. So I elaborated on this, and Mike, I think, picked up on it. I got a lot of questions, people saying, how do I play it as a retail level? Look, I don't know exactly which brokers might offer. What we do and the way we're doing it is through options. The beauty of what we do is that we spend premium, and I sleep at night very well because I know that with 100% certainty, I cannot lose more than my premium. If you're playing this through outright forwards, which might be easier to access, be careful with the leverage, because even if it's a high conviction play, anything can happen. We saw it with the Swiss franc back in 2015. So in that sense, I'm sure there are ways to do it. Our favorite way, which we do at an institutional level, is basically through options. But yeah, there might be other indirect ways. I'm sorry, I don't have access to exactly which broker offers what. But I think it's an interesting play. It's obviously not as relevant in the day-to-day, and perhaps it might be still a while away. So we have options that play over the medium term. It's not an event that might happen in the next 3 months. But it's fascinating, the whole dynamic of China and this divergence and what it means, because chess, macro is a bit like a chess game. you want to, and you need to be early in the game. And I'm very happy being very early in this, accumulating large size of artificial stuff that eventually I think 2 + 2 should be 4. But I'm sorry, Mike, I don't have a broker to direct you to, but I'm sure there are ways to do it.
I think that's a great overview, Diego. And Ralph also pointing out there are some peril if you do that. You really need to understand what you're doing so that you don't get caught up from the risk of if you're looking medium term, the risk of the shorter term bear market rallies, which could come up. And I think this is a great. Weston has been all over. The currency situation, especially when it comes to China and Hong Kong. So, Ralph, I think we're going to kick that one to Weston and get him to dive a little deeper into some strategies around that. It's something that he's been on and been flagging really early. And Diego, this is exactly why we're doing, as part of our Make or Break series, a focus entirely on China. Also geopolitics. A lot of these cross over, right? There are bridges between all of these shows that we're doing. But you're right, China is, like, all roads are leading back to what this enormous part of the global economy, what these policymakers do. I think it's going to be critical. I'm going to sort of swing it back over to the Fed because we've got a couple different questions. And I'm going to string them together because they're all related. Corey is asking, when we reference a Fed pivot, what are we actually referring to? A surprise change in policy or just a change in policy? I expect the market responds differently to that. And in the same vein, SBD 758 asking, is the risk of something breaking in the corporate bond market higher than in the sovereign bond market? And what does a Fed pivot entail? Is it just a pause, or is it bailouts of specific things in markets? Do we go back to QE? How are you thinking about that Fed pivot if it were to happen, Diego?
All very good questions. I guess the starting point is, where is the market thinking and pricing today? And you're looking at expectations that are going to take us close to 4.5% on Fed funds by Q1 next year. And this is going to come through a number of hikes that are expected. The concept of the market is, that's what's pricing, but then it's sort of looking for those hikes to reverse in some way. The pivot would be the idea that you change completely pace. You go from, okay, hiking to, of course, first pausing, but I think then cutting. And I think this divergence between hikes and cuts explains why volatility on the rate space and FX is so high. What's going to trigger that goes back to the previous questions. Obviously, at the sovereign level, it's interesting because theoretically the Fed or the US will never default because you can print infinite dollars. So you will pay back your obligation, but you will pay back into something that is worth a lot less because you've printed many green papers to pay it back. The issue comes from people who are issuing or borrowed in a currency that they cannot print. And this is why I think the move in the Fed, I was saying things will break domestically or abroad. I think there's a risk that people that were borrowing in dollars simply because nobody would lend them in their own currency. Let's face it. They might not be able to repay this debt because the service in the debt is higher through higher rates, but also the amount of debt in their local currencies increase. So you get a double whammy of pain on emerging markets that are effectively borrowed, and that could apply, to sovereigns as well as corporates. The reality is both. I mean, you just look for people that are overly indebted. Either it could happen anywhere. Think about private equity, right? People that have been funded. These things are not mark to market, and they might be taking ginormous bets on buying companies and huge leverage behind it, thinking, look, we're gonna turn this thing around and make gazillions. I think there's a huge problem in private equity in the making, and many other places, that potentially took too much debt. And they may or may not be able to to service that debt, and perhaps the businesses they bought may or may not be as good as they thought. So in that sense, the pivot could come, and I think will come depending on the severity of these things. But in some ways, it's ironic that the better the equity markets hold, and the more the Fed hikes, the bigger the effect is going to be later. So, people that are cheering in some ways that the equity markets are holding and they can cope with these hikes, I think should be holding off or holding their brakes, because this is, I would almost prefer that the market has a bigger correction now rather than pretend that they are, able to sustain this, because if the Fed keeps going, this thing we know is going to crack, yes or yes.
So that's really interesting. So it would at least signal to them that their policies working, animal spirits are being tamped down, and instead they don't really see that. Um, so I, if I'm thinking, the takeaway for all of us, and we're gonna, we have so many good questions. We're gonna have to get you back, Diego, and do some sort of special YouTube or Twitter Spaces or something. We're gonna work on that behind the scenes, because there's just so much. We're gonna look back and really, have needed to hear some of this and this stark warning. But my takeaway from all of it is that you're saying that the central banks are not going to be able to do, but they're not going to be able to rein in inflation without causing financial instability. The system's fragile. There are hidden risks. There's hidden leverage that we can't see that is going to blow up. The longer equities rally, the longer everything seems okay, the more aggressive they are, the bigger the blow up that could be coming. And that means we're going to be stuck with a system where that's blown up, a central banks that are pushing interest rates back to low or zero, sort of sustaining that
I
bizarre
think that's
world
an
we're in.
important. I think on the rate side, one of the big questions for me is, will they bring rates back to zero? And I'm not entirely sure that we go all the way back to zero, because I think they should by now know that rates at zero or negative were actually what got us here in the first place. So I think you might see, you don't have to bring rates to zero to print money. You could do QE at 2%. Why not? Right? So in that sense, it might well be that they realize, look, we need positive nominal yields. The zero and negative was emergency and aberration, which means in some ways that fixed income actually has less defending power than we thought. Because for the sake of argument, if your 10-year treasury yields 4% and yields went to zero, roughly speaking, you could make 40% gains, right, on capital. So that's a good defender, because it will give you 40% in capital gains. If yields go to 2, you don't enjoy that full defending upside in some ways. And that's a consideration for the portfolio. But the biggest thing, to be honest, of this new regime is that I think we've effectively, I have teenager kids, so I would say, look, if investing was a video game, you have 3 levels, right? Level 1 is you're trying to make money in nominal terms. And this is the way we've played for decades, okay? So here's, Maggie, here's $100, give me back 105. Okay, so we're thinking in nominal terms. We thought in nominal terms because inflation was negligible, largely, okay? I think we're now in level 2. You might come back to me and say, hey, I made 105, and I tell you, well, in fact, inflation's 10%, you lost me 5. Once you move and your brain realizes and understands that we're actually playing a different game, it's no longer about earning, your 1, 2, 3%. It's effectively keeping your purchase power and inflation. It becomes way, way harder, right? You have this level 2, and the problem is that when you're in level 2, things that work really well in level 1, such as fixed income or credit or cash, in some ways, would actually be terrible, because, think about it. I mean, not long ago, you would lend someone to take 100 euros and give it to someone, or lend it to someone for 30 years, and they would give you back less than 100. But let's assume that they just give you back, you're lucky, and they just give you back your 101, okay? Those 101 euros in 30 years are going to buy you nothing. When I say nothing, is nothing. Okay, so you're effectively short inflation when you have investments in fixed income and credit. And I don't think people have fully realized yet. And this comes from the fact that real yields are price positive. But if you live in a world of negative real yields, this is a major consideration of where you park your money to protect that capital. So that is, I think, one of the dynamics that people don't quite understand. And as I said, in addition to the risk and the vol and the carry element, the striker defender, you need the additional consideration of inflation. And just to finish the picture, people might be asking what's level 3. Level 3 is can you make money in real terms after taxes? And I think wealth taxes in particular are going to be massively higher. And this is ironically the way in which central banks and governments square the circle. They have a problem, they don't really fix it, they just kind of print and borrow their way out. This creates inflation, asset bubbles, inequality, and then you decide to fix it by basically taxing those bubbles you create in the first place. So it's kind of sad, the whole thing, but it's what it is. So I think we are now decisively in level 2, and we will see how structural that inflation is, because don't fool yourselves. I mean, inflation, of course, there's plenty of stuff on the war and tightness and lack of investment and bottlenecks. All that is true and is contributing, but the ultimate reason for inflation and what's really structural about this inflation is the monetary aspect, is the money printing and the debt, and that I think is something that will be very difficult to unwind and reverse.
There's so much good stuff in here. I'm gonna have to go back and watch that. I'm gonna have to re-rack this, Diego, and really
Uh,
start think about it. We're gonna tease all these themes out, and continue to talk about them and make some sense of it. As we close, we don't have time to go into a whole answer about this, but are there places that people can find safety and hide from this train that seems to be coming at us?
well, look, it's I would say you need to basically build the right team. You need a
Mm.
portfolio, and that portfolio should have equities and should have different things. It's not like it's the end of the world. It's just going to the bunker and it's all over. I think you need to embrace volatility. You need to be in a situation where no matter what happens, okay, there'll be rallies, there'll be things. You really need to be in a situation where you have, no matter where the ball goes, your strikers are there. Maybe they'll score goals. Your goalkeepers will defend. You need to play this match with the entire team, and you need to embrace volatility, not fight it. If your portfolio is currently very short volatility, every time volatility explodes, you're dying. You have a problem. You need to effectively find ways to get that protection. I mean, that's what we do as a fund, and there are other people that specialize in this kind of stuff. It's not just tail risk, it's volatility per se, defensive assets. I think, to be honest, gold, which is very, very unloved and has been for a while, I'm actually quite constructive over the medium term. I think, this Fed pivot that we discussed earlier, part of the reason why gold has been doing very badly is the strength of the dollar and the expectations that basically rates will continue to go up, and the fact that inflation will be under control. If this didn't play out that way, and that pivot or pause came earlier, I think that is likely to be the bottom for gold prices. And then you get other dynamics. A very important dynamic for gold is credit. It's an old adage in the market where they say sometimes you care about the return on your capital, and sometimes you care about the return of your capital. I think when credit events happen, it's a time when things like gold, physical, etc., have, I think, a place. And the third thing we haven't talked about, which is extraordinarily worrying, is geopolitics. And I think last week took a very nasty turn with the nuclear threats. And I think once these referenda take place and Putin considers this basically Russia motherland, there's room for miscalculation. So all those things I think gold proved earlier in the year it has been extremely disappointed ever since. But I think the credit, a reversal of the dollar, or geopolitics could be areas of interest. So I am very much a believer in gold over the medium long term. Once again, I don't have a crystal ball. I don't know exactly how low it can go,
Mm,
but there's been extreme pain amongst many investors. And in fact, I would argue that the trend was so strong that a lot of people might have been short along the way, and perhaps still are. But yeah, I think the answer is there's no one single place to hide. Build the right portfolio. Make sure that you're positioned to embrace volatility, whatever happens. And I think the danger, as always, is leverage. If you have excessive leverage in these markets, you are completely dead. So whether you are aware of that leverage because you just punt like crazy and borrow and sell your house and put it, these things are terrible, but beware of hidden leverage as well, and I think that's where perhaps people like us have been playing a role to try. I'm not saying it's easy in any way, but try to provide this defense mechanism to in some way balance the portfolio a bit. But you need all players, and this game is very tactical, and things are changing. But yeah, that would be my take. I think real estate is an interesting one. We might be heading for, particularly, I mean, certain areas with super high rates might be heading for a lot of trouble. But over the long term, with basically deeply negative real yields, actually it's not a bad place to be, provided you can survive and pay the mortgage, and you don't have excess, and you have a job, etc. But it's a fascinating market because things like real estate or oil or others could perfectly be in this short-term down,
hmm
and that makes the whole thing so much more difficult, and why your portfolio needs to be truly diversified and embrace this volatility, and perhaps think long term, and make sure you survive whatever happens. But yeah, it's
Absolutely.
not it's
Well,
not easy. It's not easy.
it's not. It's not. I know even for people who have a lot of experience like you, these are tricky times. But Diego, we so appreciate this was like a double, a twofer for all of you. We appreciate all of you sticking around too. But it's really important to try to make sure you take all of this in and do what you can to preserve the money that you worked really hard to earn and put away and save. So we hope that these different perspectives help you do that. I think Diego's shot actually froze. Maybe Skype is trying to tell us something, but Diego, we can still hear you. So thank you so much. We're going to try to figure out how to get you back on so we can get some of these questions in because it was just fantastic. So thank you. And thanks to all of you for putting in all those good questions. We appreciate it. Want to give you a heads up. We, of course, will be watching that jobs number tomorrow. I'm going to be doing a deep dive on the labor market. We will be back with our daily briefings. On the crypto daily briefing, Ash is going to have Raul live taking questions. So we didn't talk about any Bitcoin or ETH or what role that might play in a portfolio, but they'll be all over that tomorrow. So get your questions ready for that. That's going to be live. Ask me anything. And then I'll be back with Peter Bookvar tomorrow at 4 p.m. So thanks so much for your extra time today. Take care and good luck out there.